All right. Well, so my name is Eric Martel. Bobby. When I was 18 years old, I was still at university, and really I kind of talk about a little bit about my journey and kind of like we're talking about why I think I'm successful. And it's really about kind of like the decision that I made and the decision that I made that made me, or the actions that I took that made me change kind of my mindset and my behavior. So graduating next year on math, for those of you who don't know, this is the math of financial risk. So I do a lot of math. Last time I mentioned that, she said, woohoo! So, not this time, I'm sorry. Lost millions of dollars on the dot-com crash, 2000 and 2001. I was working in tech with tons of stock options. It was great. And then lost them all in the dot-com crash. And then that really kind of triggered me. Again, how you react to certain situations is very important. And for me, that's really focused my attention on achieving financial freedom and having more control over my investments. And this is when I really started to look at other businesses, other things, and then eventually came back to real estate investing, launched Martel Turnkey, and very recently last year we launched also Flip System, and I'm going to talk about briefly about these two things very late, because that's not the main thing. Sold my house, so I'm very numbers driven. So I sold my home in California, invested the proceeds in the equity to accelerate my real estate investing, and I became instantaneously financially free, accredited investor, all that good stuff. So, and then after I made all these decisions, I said, well, I really have to get the word out. I want to talk to other people. I was talking to my friends. I was not on a salary anymore. And then when you're working, you don't have a W-2, you don't have a 9-to-5 to go to. You're looking for people to play with during the day, and or go for lunch with, and it's very hard. So I have to convince other people to do the same, so I have more friends to play with. And then part of the thing that I did, wrote a book, Stop Trading Your Time for Money. It's on Amazon. Also do a couple of YouTube channels, one under my name, Eric Martel Official, and then also Break Away from the Rat Race, where I interview different investors, different people that have different ideas about achieving financial freedom, how they did it, and hopefully help you do the same. And then I think I interviewed Bobby on that a couple of times, I think, right? So very active on social media, or I try to be. Try to post as much as I can, new information that I found, or things that I read, and my own perspective. So why did I focus on financial freedom? Why it's so important? And then the key is that it's inevitable. You're gonna get there. Everybody, at one point, you're not gonna be able to work, and then you're gonna have to have money coming in. If you're counting on Social Security to pay all your bills, you're gonna be surprised. If you're counting on that plus your 401k, you have to figure out how you're gonna extract the money from your 401k, minimizing your taxes, and then to achieve financial freedom, because that's still a bunch of money. It doesn't tell you how to invest it to have passive income. And yes, you could do the 4% asset withdrawal method and stuff like that, but there are some challenges with that as well. And we can talk about that. I don't have a slide on that, but we can talk about that as well. So let's go back to kind of like my parents, and I think a lot of people's parents too, is that working paycheck to paycheck, right? So my parents, boomer generation, and they were happy. They were just like, going paycheck to paycheck. I was miserable, but they were happy. I wanted a lot of stuff, and they just didn't seem to want that stuff. But yeah, living paycheck to paycheck, paying their bills, and really, in terms of the financial system, in terms of banking, in terms of their understanding of money and investing, they had nothing. My father never invested in the stock market directly. Of course, the fund, the retirement fund that he had, invested in that. But really, he didn't have a very deep understanding of how this is all put together. And an event like this with Bobby and his team and all the associates and the collaborators here is really, the education that you're getting here is like, it's real. It's telling you about the financial system. How do you get money? How do you get private money lenders into your deals and stuff like that, and do that legally and all that kind of stuff? But very different than my family, my parents' generation, where they didn't have to worry about retirement because retirement was taken care of by the company that they had, and they lived happily, no worries, and then they had a retirement, they had a defined benefit pension plan at the end. My journey, very different. Moving around, stock market, lost a lot of money as I mentioned, but also after that, I decided to start a couple of businesses that would do passive income eventually. So a sauce business, I had a low-carb grocery store, and here's my wife here at the grand opening of our low-carb grocery stores in San Carlos, in California. All these things, they take a lot of time to learn. These are different businesses. I had to learn things from scratch, from ground zero. How do you do a grocery store? That's one thing. Then you kind of grow that. We did catering, we did private chef, we did a sauce company after that. Completely different business. Completely different business that you have to learn from scratch. And it's time consuming, and it takes a long time to ramp up these businesses. Luckily, don't do any of that stuff. We're gonna do real estate. It's the easiest thing that you can do, and this is why I ended up focusing on that later on. But why are people focusing on financial freedom? Why isn't that on everybody's mind? Everybody knows they're gonna retire one day. And I think there's too much noise. There's too many fake gurus out there that are telling them, or the Wall Street is telling you, invest in the 401k, invest in the 401k, because they want your money so they can get their fees. They're not really worried. Nobody is talking about how that money is going to give you financial freedom at retirement. And I have another slide, okay, so I'll stop at that. But people don't know what to do. So they invest in 401k. Well, what else am I going to do, right? So they don't know anything. So here you're way ahead of the curve. Here you're already thinking about investing your money directly, and investing in real estate is probably the easiest and the ideal way to invest and eventually build wealth and achieve financial freedom, right? And of course you have the people that have their head in the sand thinking that everything's going to be taken care of, the government will take care of me, and all of that.
Yeah, right.
Well, not too many people hear about that, right? Okay.
That's why you moved from California, right?
Yeah, exactly. Yeah, we've been taken care of there in California, that's for sure. So retirement plan, let's talk about that. 46% of millennials said that it would take a miracle for them to retire securely. So this is a very recent survey. 46%. They can't even imagine they're going to retire. And honestly, that's kind of the thinking that I had maybe like 15, 20 years ago. I said, I'm gonna work till I die. That's my retirement plan. Hopefully I die early, so I don't waste time. Right? But so that was my plan, honestly. And I was just like, okay. And but they have a lot of but then I might kind of change my thinking, right? So a lot of people that had defined benefit plan, defined benefit pension plan. Anybody knows what defined benefit pension plan is? Wow, unbelievable. This is amazing. Corporate America did a fantastic job getting rid of the most important and the best retirement plan. How much retirement you're going to get when at 65 when you retire? It tells you that you're going to get, let's say, 50% of your final salary at retirement. You don't have to worry about investing. They're going to invest it for you. If the stock market crash, they're going to fund the difference. If the fund goes up and the market goes right, then that's good for everybody. But you know up front that you're going to get a retirement that's going to cover 50% of your final salary, roughly. Depends on the years of service and stuff like that. But that's kind of what happened. So you have a defined benefit. You know how much you're going to make. The rest is going to come from Social Security, and the rest should come from investment. But that's it. Nobody knows about it, right? Nobody has that anymore unless you work for the government or something like that. Then you probably you've never heard about that. And then the other thing too is that when there was a big movement from corporate America to convert all these defined benefit pension plans into basically 401ks. that basically puts the burden on you guys, on everybody, to save and to basically, and invest that money, and then put the risk of retirement on you. And when you have defined benefit, you don't have to worry about that. They have a manager, they have someone that invests. Now that you have your 401k or your IRA and all that kind of stuff, the burden is now on you to invest that money, right? So, and 401k again, tax deferred, so it's not tax free. You're gonna have to pay tax one day. So you have to figure out the best strategy to get that money out of the 401k. So one of them was the 4% asset withdrawal method, which is it works okay, but it takes a lot of money invested in the stock market in order to do that well and to do that consistently. Also, a lot of people, when you're trying to determine how much money I have to save in my 401k, I want to know kind of like, okay, well, when do you plan on retiring, right? So a lot of people think that they're going to retire at 55, or they're going to retire at 60, or at 65. Well, if you're planning to retire at 55, well, that means that you won't be able to extract your money from your 401k because you're going to have to pay special fees, right? You're going to have some special fees associated with that for early withdrawal of that money before 58 and a half. So that's part of the problem. So you have to really think about that when you plan on retiring, and then also most people don't know when they're going to retire, right? So about 60% of the people, I think it's on the next slide, but 60% of the people don't know exactly. Do you think they're going to retire at a certain age? Do you think they're going to retire at 65? But they end up retiring at 60, or they end up retiring at 55. Why is that? Any guesses? People get sick, they have to take care of a sick one, or a late career layoff. A lot of people, when you get laid off around 50, 55, it's tough to find a job after that. And it's also, you may find a job, but you may not find the same salary that you had before. So it's something to think about. And also calculating, when you talk about your 401k, the savings and need, how much money do you have to save? How much money do you need at retirement? How much money, how much savings then do you need in order to basically have enough money to do that asset withdrawal method that I was talking about? And then when we look at these calculations, you come up with a huge number. You come up with numbers like $1 million in savings, $2 million in savings, in order for you to retire with enough money to do this asset withdrawal method that Wall Street wants you to use, and to get that financial freedom. And guess what? The median retirement savings for those 55 and 64 is $90,000. So $1 million minus $90,000, there's a big gap there. So, and if you're 55 and you wanted to retire, so you have 10 years to save $1 million, well, then you're good luck. Good luck with that. Right? So you have to start early, or you have to have a different strategy. The other thing too that, don't worry, it gets better at the end. So that's a downhill part of this presentation here. So full-time employment is under assault. So gig economy, obviously, a lot more gig economy people that are on Uber, Lyft, contractors, even on like software development and stuff like that. A lot of people on contracts. It's good when it's good. It's also not so good when it's not so good. And that means that you get no benefits. You're an employee on demand. They need you. They don't need you, and stuff like that. And then you just basically, sometimes it's good, sometimes it's not so good. Large companies are pushing a lot of the changes to go more and more towards the gig economy. It saves them a ton of money. Oh, you're going to work 30 hours next week, 20 hours, and then 60 hours after that, and then you're going to be happy to work 60 hours because you only work 20 hours. So that's like it's a great world for them to be able to do that. And they're really pushing a lot of the legislation to allow more and more contract workers in their businesses. Working from home also sounds great, but there's a downfall to that. in my opinion, is that when you're working, let's say you're working at in San Francisco or in Miami, you work at the office, you go to the office, you talk to the manager, your boss, all of that, all is good, and then you end up that, okay, now you work remotely, right? So you work, I said, I don't want to work here anymore, I want to work out at I want to live somewhere else in North Carolina, and I want to work remote and stuff like that. This is great. So far, so good. Then, as a manager, when I'm working with my employees, I'm working, when I'm working in Miami, in the office, I'm really competing with people in Miami for that job, right? Whether you're in and out of the market doesn't matter, but you're competing with people that are in the same market as you are. When you're working remotely, that pool of resources is expanded dramatically. If I work out from home in North Carolina, and then my manager is working with, his team is working in North Carolina, they have some guy in Texas, another woman in Canada, 3 people in India, all of that. It's like, it doesn't matter anymore where you're working, so that means you're competing with people everywhere in the US. Not just people in the Miami area or the Fort Lauderdale area where you're close to. So you're competing with everybody in the US, and I would say even the world in some of these for some of these jobs. So the end result of that is that inconsistent income, because you have some 20 hours here, 40 hours here. That doesn't look very good when you're trying to get a loan. And you have all these peaks and valleys. You may have gaps also in income. You finish a gig and you start another one like 3 months later. So how do you fill this gap? Also, gig workers in general, they earn 58% less than a full-time employee. Their rate increase is 2.7%. It's more competitive when you work as a gig worker because you don't have that long kind of like relationship, I would say, than if you're full-time. Average number of hours, 5 hours. They're trying to keep it just below the legal limit, so they don't have to pay you benefits. And then, I have to say, impact on credit, impact on savings, and impact, of course, on retirement. If you can't save, if you can't get a loan, then it's going to impact all those things, right? And I don't have a slide, luckily, on recession and inflation. So that I don't want to be too negative. Right? So that's why my thing is that financial freedom should be your number one goal. It should be your number one focus, right? But how do you achieve financial freedom? I've seen a lot of people. Everybody tries to do that, even if you know that this is what you want to do. Say, well, how do I do that? Well, if your goal is financial freedom, then you want to look at strategies that are going to give you passive income and financial freedom. Make sense? Right? So a lot of strategies out there, they're not passive. You have to work hard at it to make it work. And even in real estate, there's lots of strategies that that you have to work hard at. Like wholesaling is a good one where you can make good money, but it's not passive unless you train a team to do that for you. So finding the right strategies to do that, but also having the right things to support it. Everything has to be in alignment. So if you want to do single-family rentals, you want to find the right market for single-family rentals. Otherwise, that strategy won't work, right? So if I want to have a cash-flowing single-family rental in San Francisco, not going to work. Right? It's not. If you put 100% of the funds in there, it might actually cash flow a little bit after you pay all the property taxes and all that. But it's not going to be a great investment because your return on equity or your cash-on-cash return is going to be very low. Right? So when I moved to California, that's what I was looking for. I was looking to invest in real estate, but I couldn't find anything. And if I had put enough cash for it to cash flow, then my cash-on-cash return would be around like 1%, maybe 2% if I was lucky. Who wants to invest 2%? I'm looking for private money lenders. So that's the market. And of course, you have to have the resources, right? So by resources, I mean time and money to do that. So that's very important because some strategies that I mentioned, they take a little bit of time to ramp up, you know, so you want to make sure that you have the time and you have the money to do these deals right. Okay? So basically, this is in my book as well, Stop Trading Your Time for Money. So I basically looked at the number of passive income strategies, and then I said, okay, let's look at, here we have the time, how long it takes to basically get this strategy off the ground. Right, so this is the x-axis here, and then the vertical axis is the risk. How much money do I have to put in there? What is the potential return? What are the potential issues that could happen with that? And then when you look at this, I mean, if you look at that, like value add apartment, just because there's a lot of more money that's involved, there's a little bit more duration. If you're trying to, to do the renovations and stuff like that, you have to turn over the units. There's a little bit more work involved, definitely. That's why the time is here. It's also more risk because there's more money involved, and more moving parts and all of that, right? And then you go, so obviously, where do you want to go that's the best for your time and for the risk that you're going to put in there? Which quadrant do we want to focus on? This quadrant here, right at the bottom left-hand quadrant. And at the very bottom here, so of course it's as scientific as I could make it. So don't say, oh no, this one should be a little bit higher on this one. So, but roughly it's around, to me, like it's about relatively the right kind of like areas that it should be. That's why I'm focusing a lot on the turnkey single family rentals. But you can also do like BRRRR strategy. You can also do turnkey apartments if you find something that makes sense. Private money lending too is also something that you may consider. But this quadrant is ideal, and this is the BRRRR strategy. Everybody knows the BRRRR strategy. Yes. So that's kind of where it is. So takes a little bit more time to do that. Takes a little bit more money, a little bit more risk, obviously. Okay. So, any questions on that one?
What's the BRRRR strategy?
What?
What's the BRRRR?
The bird strategy.
The BRRRR strategy is a strategy where you buy distressed property, you renovate it, you rent it out, you refinance it, and then you repeat.
Flip it.
It's a strategy that was popularized by, was it David Green who did that?
Yeah.
No, it was the other guy.
Was that
Brandon.
Brandon?
Brandon.
One or the,
Yeah.
you're twins. Not identical. All right. So, question is like, okay, well, I want to invest in real estate, but is it a good time to invest? Should I invest now? And the question is, yes, you should. This is the interest rate, 30-year mortgage interest rate from Fred, and you can see that this black line here is the average over this whole period. Since the 70s, the average interest rate is 7.5%, roughly. Okay? So what interest rate are we at right now?
6.5.
Yeah, well, this one says 6.15, but then when you actually try to get a loan, it's going to be a little bit different. But you can see it's below that line. So when people are saying, oh, the interest rate is too high, stuff like that, it was because it was artificially low because we're in trouble. This is not, it's not going to happen again, hopefully. But, so that's kind of where we are. The interest rates are at a decent rate. I think they're still a little low. I think if we look at the average, it's probably going to go up a little bit. Probably going to stabilize again around 7-8%. That would be a pretty good interest rate. All right, and we're looking at inflation as well, how it's reacting, and the inflation rate I think is 6.4%. So again, the inflation rate and the interest rate about the same rate. That means that you're basically getting money for nothing, right? So a very good investment. Now, the exercise I want to go through here is about investing. So if you don't want to invest, you say, well, I don't want to invest because this is too scary. And this is something that happens, it's very natural, right? I mean, we look at these little bills and these things that are printed by the bank, and then say, oh, wow, this is great. Even if you have bills, I think I have some bills. I have those things, but I normally don't carry them with me. But the thing is that it's a little bit of a kind of an illusion. I mean, it is kind of there, but there's a lot of what's really important is the purchasing power that's associated with that. And here, so this is what I'm going to illustrate here. And when we are scared, when we think that we're unsure of the economy, what do we want to do? We want to kind of like herd it, and we want to keep the cash because we think the cash is safe, and we put that in our sock drawer. And this is what this guy is doing here. He has $25,000, and just to illustrate the idea of purchasing power, I basically have like these fictitious cups of coffee, $5.
Starbucks?
Maybe I should point here. $5 cup of coffee. So with $25,000, I can buy today 5,000 cups of coffee. This is very good. I like coffee. So this is what you do here. Now 5 years down the road, so you know you put that $25,000, you put that, you don't buy your cup of coffee, you say I'm gonna keep it, I'm gonna put it in my sock drawer, and every morning when I put my socks on, I'm gonna see my $25,000, I'll feel safe. Right? 5 years down the road, assuming 5.4% interest, inflation, you end up that you can buy only 3,844 cups of coffee, because the price of coffee 5 years from now is $6.50. It doesn't seem like big of a deal, right? It just kind of increased only $1.50. If you went to the store and a couple of months ago now, and the cup of coffee was up $1, nobody would be screaming. But this is the impact here on just that cup of coffee, that inflation. So you're basically reducing your purchasing power by 1,000 cups of coffee. And if you like coffee, this is very sad. Right? So this is the effect of purchasing power. Now, let's talk to this person and say, okay, well, here's something else that you can do with that $5,000. And this is why it's so important to invest in real estate and in cash flowing real estate. So I'm going to take my $25,000, and instead of putting it in my stock drawer, I'm going to invest it in a single family rental. It costs $100,000. I'm going to put $20,000 down on the purchase of that house, right? I'm going to pay $5,000 in closing costs. So this is like money that goes away that has no value to the deal. I'm left with an equity of $20K, right? I'm going to do that deal. I have a loan of $80,000. A couple more assumptions here. Rent, $1,000 a month. Mortgage payment, $559. Other costs like for insurance, property taxes, and then that property cash flows around $240 for this particular purpose. I'm assuming interest rate 7.5%. Right? We talked about 6.5, so I'm conservative here. Inflation 5.4%, and appreciation 3%, and rent increase about 5% a year. Make sense?
That makes sense.
So after 5 years, my house is now worth $115,000. My loan balance is $75,000. I didn't pay that loan. My tenant paid that. My tenant paid down $5,000 off my loan. Total equity, $40,000 that I didn't have before. I started with $20,000 in equity, now I have $40,000 in equity. Now the accumulated net cash flow over these 5 years, assuming the rent increase and all that kind of stuff. So this cash flow here is $240 in the first year, but as time goes by, the actual cash flow increases because your mortgage, the biggest item here on your expenses is the mortgage payment. That stays the same. The rent goes up, the expenses go up, but the mortgage stays the same. So your net cash flow actually increases, right? So over time, and then you end up that after 5 years, you didn't even invest that money, so you just kept it, and then you have $19,000 in accumulated net cash flow. Okay?
Got it.
You add all that together, $59,000. Not bad. How many cups of coffee? 9,000 cups of coffee. So now we've gained purchasing power. We gained 4,000 more cups of coffee. So this is why investing in real estate is critical. And the reason why this works is because it's cash flowing, and that's because it's leveraged, highly leveraged. Right? So if you do something like this, it's going to increase your wealth, which is these cups of coffee. You have more purchasing power, and yeah.
You're assuming 5% increased rent income.
Now, how do we get these single family rentals? Where do I get a single family rental for $100,000? Eric, you're crazy. So Martel Turnkey. This is the advertising part of the.
St. Louis,
There you
Michigan.
go. So what's turnkey?
Miami.
What's turnkey rental? What does that mean? It means that it's done for you. So we've identified the market. We've identified the properties that make sense, the right neighborhoods with low crime and all that. And we've acquired these distressed property, we renovated them, we find a tenant, and then we connect all the dots in between. We basically are connecting you with the property manager, we're connecting you with a lender, we're connecting you with an insurance company, all that kind of stuff. When you buy the property from us, it has a tenant in place, it's been renovated for the tenant, so a lot of the mechanicals and all that kind of stuff have been serviced or have been replaced, and then you have a cash flowing asset that's cash flowing from day one, right? So it really simplifies the buying process and everything, because we're connecting you to everybody along the way, and you can build your portfolio very rapidly. So if you want to have 10 single family rentals tomorrow, you have the cash. We can do 10 properties tomorrow. That's not a problem. If you're on the lender, it takes a little bit longer, but within 6 weeks, you can get some single family rentals and build your portfolio that way. A little bit different if you want to do the BRRRR strategy that we talked about. You have to buy the distressed property. You have to figure out the contractor. You have to manage the contractor through the process. You have to get enough money to be able to pay the purchase price, pay the rehab, all that kind of stuff. Takes a long time to do that. The refi also takes a little bit of time because you have to wait for a seasoning period. So once you have the tenant in place, you have to wait for a seasoning period to do the refi. Here in this case, because we're selling the property to you with a tenant, you can just do a regular mortgage because you're buying the property from us. So you can build these turnkey portfolio very quickly and very efficiently. There's minimal risk. These are the markets that we're in: Memphis, Cleveland, St. Louis, and Detroit. Maybe when I put it closer.
Yeah, I was gonna say that, but that's, yeah.
Some examples of properties we have. I mean, they're pretty much around the same kind of price range, the same kind of return. Here, that the investment that you would get, the potential ROI that includes the net cash flow, that includes the appreciation and the mortgage pay down. So, 1,000 square foot properties up to, I didn't know we had a 1,400 square foot property, so that's good. But 137, so to give you an idea of what, pretty much the same thing. We kind of always do the same kind of finish, and then you can go on our website and you can go and click on the indoor inside pictures and see what the renovations look like. But this is what this particular one looks like. St. Mark. Rental income for that property, property taxes, property management, the net operating income 842, and then you have the debt service, which is the mortgage 600, and your cash flowing about $200 a month. Okay. So that is at this particular interest rate with 2 points. So it's pretty reasonable. So our advantage with Martel Turnkey is that the cash flowing in from day one. So that means when you buy the property, there's a tenant in place, and it's cash flowing. You're paying rent already. We never overpay. We actually have something that's called appraisal matching. So we sold the property to you and say, well, it's $120,000, and then when it comes time to get the financing from your bank, it says, well, the appraiser says, oh, it's worth $115. Then we can reduce the price to $115 to match the appraiser that you get, the appraisal that you get. Okay, so that way you don't have to come up with more cash at the end. And then third-party property management company, meaning that we're not, sometimes we find that there's a little bit of a conflict when you have the same person that is doing the renovations and is managing the property after the fact. There's a little bit of, I can kind of cut corners on the renovation so I can charge you back after you purchase the thing. So we didn't like this idea, so that's why we're using third-party property management company. But that's it. Now you're gonna say, well, you know, that takes a lot of money to do that. I really wanna have more hands-on, and I wanna do more like the burr, I want it to be a combination, and that's what a lot of people do. You have to build the capital somehow, so you wanna do a little bit of burr, get some capital going, or do a fix and flip, and get some capital going so you can buy a turnkey or do a burr after that. So that's why we package all our experience that we've seen with Martel Turnkey, our systems and all of that, and we've created a flip system. And that's not all. So flip system, so we've packaged everything. So we basically, step-by-step real estate training. So we have a formation training program, all recorded videos about the real estate investing, how to do that. We also, this nothing special, everybody does that. Winning formula processes and scripts. So a lot of the scripts, templates that we're using, we provide that with to our students. Again, you know, a lot of people are doing that. Fully automated CRM. So this is something that the system that we're using that has a lot of automation. We basically pared it down for our students, and we're going to keep adding new features into that. So this is a system that's going to help you track all your properties, not just the flip system properties. You want to find your own deal, or you have properties already that you want to manage through the system, and you can do that, and it's going to allow you to do that. Lots of automations and lots of new features coming up into that. Then we have the acquisitions team. A lot of people get started and they say, well, I can't find deals. Well, we're gonna find deals. We have our team has been analyzing deals for Martel Turnkey, and they're gonna find deals for you. They're gonna analyze them, they're gonna enter them in your CRM, and then you're gonna decide if you wanna put an offer or not. And then we have a dedicated real estate success coach, because we know it's tough. It's tough to get there, and it's tough. The work is not necessarily tough, but it's you have to be disciplined. You have to be willing to move forward, and you have to be pretty active to get your deals through. And often, I mean, I've been there. I mean, I've been the first house that I bought in Memphis, and it was like $40,000, and I was afraid I'd lose my $500 in E&D. Like that's what I was afraid of. I hope I don't lose my E&D because I committed this. But you know, so this is the kind of thing, and then I think a lot of people need the success coach. It's really an encouragement, saying that, you know, you're on the right track here. You're doing fine. This is okay. We're reviewing also some of the scope of work or the estimates that they're getting from their contractors, inspection reports, and all of that. So we have one of the coaches actually a construction manager for Martel Turnkey, so he's involved in that as well, and he's reviewing everybody's estimates and all that kind of stuff, and inspection reports. So lots of experience there that comes into play to help you succeed in your own business. And then that's the system. So it has a whole community of investors as well. As we're all on Discord, and then you can talk to other investors that are doing deals in the same markets that you're in, or in other markets, and learn from them. We have a call like every Tuesday where all the investors are join in, and then we share kind of like what's going on, what problems are they having, and you're really learning from other people. And then we have all the coaches that are there every step of the way to help you 24/7. We try to have always one person awake. So any questions? Yeah.
Are most of your students on your flip system, are they new?